From the morning reading, the S&P is now a mere 0.55% from a record close. Asian and European equity markets were mixed, but the major U.S. cousins pointed uniformly towards modest gains. The Nasdaq ended the session up about 0.25%, the Dow about 0.33%, and the broader benchmark S&P closed with a 0.33% gain. The 500 traded in a narrow but choppy range in the morning and a narrower afternoon range that included its 0.4% intraday high. That 0.33% closing gain was right at the level of yesterday's intraday high. The index is now a mere 0.55% from setting a new record close and continuing officially the bull market. Spiders XLE, XLU make new high close. Steel stocks gain. AMBA surges forward following resistance breakout. 8 of 9 sectors moved higher on Wednesday. XLI, XLU, and XLP were the strongest sectors, while XLE was the weakest sector. Oil futures rose $1.10 to close at $51.53, its highest close since July of 2015. Breadth strengthened as advancers led 2,033 to 969 on the New York Stock Exchange and led 1661 to 928 on the Nasdaq. Tuesday's shooting star of the spider did not confirm on Wednesday, and the short-term trend continues up. Also in the morning reading, industrial spider nears new record. Rails are back on track, led by CSX and Union Pacific. Commodity indices reach bull market threshold. Materials also show market leadership. Nucor leads steel stocks higher. Falling bond yields help gold home builders tick up. It's been a long time since we've seen a big down day. Like recent discussions, the S&P hasn't had many large up days during the past several months, but it hasn't seen a single large down day for 2 months. That could be construed as complacency, but the S&P's future returns after similar streaks don't confirm that idea. The past few days have been enough to push stocks far above trend. The S&P is now 2 standard deviations above its medium-term 50-day moving average, a signal commonly used as an overbought indication. When coming into a multi-month high in stocks, it has a mixed record. The VIX fear gauge has increased as the S&P 500 has rallied every day this week. The percentages aren't large, so it's not like there's evidence of a massive rush to hedge positions, but it's still unusual. The last time the S&P and the VIX both rallied 3 days in a row was more than 3 years ago. In the past 20 years, there have been 7 instances. Returns over the next 1 to 2 weeks were tepid, but the S&P showed gains over the next month almost every time for what it's worth. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:58 a.m. Mountain Time, and I am recording this in preparation for the market day of June the 9th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And right off, I need to give a caveat here. We're in the middle of rollover on the 4 U.S. indices, and many of these data packages, when you pull up your charts today, depending on your broker, they may well already have continuous contracts being quoted on the new contract, even though most of the volume is still trading on the old contract. So these numbers here are being picked up as new contract, but our focus here isn't so much the number 2109 as the prior day close, or the current Globex low. Though that information can be very useful to especially short-term traders. Primarily what we focus on here is what is the net change, and the net change is being quoted as down 0.75% on the S&P, the Russell down about 0.9%, the Nasdaq down a little less than 0.5%, and the Dow down about 0.75%. On the crude oil, down about 0.2%, Euro down about 0.5%, bonds up about almost 0.5%, and gold essentially unchanged. China and Hong Kong apparently aren't open. The date quotes were coming in from 6.8. Japan was open, down about 1%. Germany down a little over 1%. And United Kingdom down almost 1%. So in terms of these quotes, just be very careful, especially if you're a short-term trader. On rollover days, volume is often choppy with poor follow-through to setup signals, as volume is split between the two contracts. And until the primary volume gets rolled all onto one contract, things can be pretty messy. Friday, we'll see most of the volume start to be on the new contract, and Monday usually sees almost all the volume on the new contract. So this is usually a kind of a 2-day process, once a quarter, and Thursday and Friday is when most of the volume is in shifting modes. In terms of if you're not a short-term trader, you still have to be aware that rollover has an impact on your chart signals. So it's just kind of a messy time. In terms of macroeconomic reports for today in the United States, those of note would be the weekly employment claims, nat gas storage, we have a 30-year bond auction, all would be of mention for today. And you see here bank holiday for China. In terms of looking forward to tomorrow, we have the University of Michigan Consumer Sentiment and its associated inflation expectation report. In terms of current volatility conditions, we have been increasing on the 5-day versus 10-day. Short-term VIX, kind of mixed. You heard one of the morning authors mention how the VIX has been rallying the last 3 days. Short-term VIX down under 11 to a 10.89. Skew just over the 125 threshold to be considered a warning status. And the IV percentiles continue to be exceptionally low, with the S&P at 11, the Russell at a 12, NASDAQ at an 8, and Dow at a 5. We did have a standard deviation move put in by the small caps yesterday, the Russell up over 1 standard deviation. And you see just how quiet things have been in recent days. And another morning author mentioned about that, where we've not had any significant down days in the S&P in really 2 months. Many of these updates have also been relatively small, and indeed in the last 2 trading weeks worth of action, there's only been 1 standard deviation move, and that's about 25% of normal. Let's go ahead and go to the charts. And S&P futures, again, this is probably, this is on the old contract. So you see how different services, TradeStation was quoting on the new contract, and Thinkorswim still quoting on the old contract. So this is the kind of mess that you get. So, I mean, obviously chart patterns are going to be the same, and that's our primary review effort right now, as we're doing a kind of a technical analysis review of chart patterns. But in terms of absolute numbers, you know, there's going to be a difference between the absolute numbers. On the old contract, you're about 2110, while the new contract is about 8.5 points lower than that. So just be aware that there's that differential going on between the 2 contracts. And much of that overnight drop could be associated with moving from the old contract to the new contract. It's not actually, in effect, down as big as it might seem, depending on which pattern you're quoting. So you see, we continue to push up into this area of resistance. So this is, you know, becoming pretty interesting. We're still not achieved a real breakout in terms of actually clearing anything. But as we continue to spend more and more time up into this area of resistance, it becomes more legitimate that this is not just an immediate head fake, as is often the case. So we'll continue to watch this. In terms of probabilities, it's very hard to assign probabilities right now. You saw one of the quotes from this morning was that, you know, we're up 2 standard deviations from the 50-day. So things are starting to get pretty stretched to not have any kind of pullback and kind of normal exhale. Remember, you can't just inhale forever. You have to at some point exhale, and the market does the exact same thing. And the longer you take to exhale, often the larger that exhale becomes. So a lot of things that are starting to build in this big move off of the failed breakout of the head and shoulders pattern from the lows. At one point, we were down here around the 2020 area, and we've gone, some 100 points without so much as an exhale to speak of. So we'll continue to watch this. If we do pull back, the question will be, does it just pull back to a fib retracement or a key moving average? Even a half back, would bring you down 50 points, but do no damage whatsoever ultimately to the bullishness of the short-term pattern. So on the Dow, still heading up against this former swing high. Nothing really achieved yet. NASDAQ, of course, has been doing kind of a similar thing up against former swing highs and not really achieved anything remarkable yet. So we've made a big move on many of these indices, only to really just kind of do the easy lifting and not really done much hard lifting of yet. The S&P is certainly the most pronounced, and the Russell, clearly has, made the biggest move in respect to coming past this former swing high. But then if you look further back, you've got, a long way to go to get back towards the all-time highs, whereas the S&P is nearly 0.5% away from all-time highs. That could be achieved in one trading session. The Russell's got much further to go, so does the NASDAQ. It's not going to make up its ground to get back to its all-time highs in one trading session by any means. In terms of the volatility, we continue to just chatter down here at these very, very relative low levels, and nothing significant has happened really in quite some time. We've had a couple little minor pops that are immediately resolved. You see how thin the cloud is getting here. Some of this overhead resistance is going to start kind of going away just because it's been chattering down here in the same area for so long. So in terms of this big energy of this kind of move coming off, much of that has ebbed away now. Let's take a look at, say, crude oil. Crude oil continues to make its big advances. Nothing really showing any slowing of momentum or energy there. Gold made a big move in recent days. And, of course, this was kickstarted by action from the anticipation of interest rates, and the probabilities associated with that have changed. And then also other action with the dollar, has helped push gold back up from the precipice of falling under these important levels of support to now about 2/3 of the way back to where it was at these recent swing highs. So we'll continue to watch this, but really, really messy pattern here that's been occurring in gold on kind of the short to intermediate term. And I think we'll just look at bonds, and that'll be about it on the charts. So bond continues its breakout, and we've now cleared these recent swing highs. So we'll see if this can build on this action today and close. But really, we're getting to the point where there's just open air above the bond market. So you kind of wonder what equities do when bonds are climbing to such a point. Let's go ahead and go to the daily report. And a few changes here from yesterday to contrast. On the top, all the same. Still intermediate term phase opinion, phase 2, the bullish trend reversal phase. The market timing signals, all three of them, no change. IBD still a confirmed uptrend. GMI index still a perfect 6 out of 6. Stock charts decision point scoreboard, no changes. Still a very good stack with short and intermediate term, and the mixed stack of bull and bear signals on the long term. Consensus of the signals, of course, is bullish, with that kind of asterisk of this long-term pattern needs to be taken out before we're actually in what we would call the healthy bull market. Position sizing opinions at 100% on both systems. Intermediate term market posture, severely strong bull, and you see up over 90 for the S&P benchmark as well as for the NASDAQ and the Russell. Dow continues to improve, though it's not as strong as the other three. It's only 6 points away from going up over 80 and joining the others in terms of the severely strong bull kind of definition. In terms of hedge warning status, still at level 1, which is a caution light, or first level of increased warning, as it were. In terms of special opinions around our strategies, option income strategies, covered calls, put selling, no new changes from the beginning of the week on those. In terms of special opinions from various indicators and going into caution or warning status, the volatility ratio warning fired 2 sessions ago, so we'll see if we see an increase in volatility. VIX futures are still in a daily squeeze. You see the distribution day count just barely holding on to warning status for the S&P, and frankly, some of these distribution days were just marginally high. In fact, 3 of these. So the distribution day count is getting close to becoming a non-issue and going into more of a normal status. The primary thing that we've been looking at is that this key intermarket risk aversion indicators are now all 5 flagged as risk off, and we'd like to see that go away to be able to see our hedge warning status drop to a 0+. In terms of sentiment, no significant changes from yesterday. Short-term stocks and bonds are at pretty high sentiment. SMH, the semis on the ETFs, is at pretty high extreme sentiment. And the overall market is in an extreme greed kind of area. So all these are giving us signs to say, hey, keep an eye for potential reversal patterns, but in themselves are not signals for a turn. In terms of percent change, as we go to sectors, you see it's a sea of green, and retail, had a lot of damage to fix, but it's just about ready to do that. In terms of percent change on the sector specific by the day, you see what were the winners yesterday: industrials, materials, utilities, consumer staples. So a mix, frankly, of high beta and low beta, more defensive kind of sectors here at the top. And really not a lot of separation between most of these sectors. So it was just generally a broad up day for most sectors. Now, telecom and energy were kind of the exception, but they're not down by much for the day. And certainly the 5-day, 1 month, 3 month, all these, in fact, even on the year to date, with us in the market and up near the former swing highs of the broad market swing highs for the S&P, these are all looking pretty good right now. So things are starting to be, fairly consistent for the bulls on just about every metric. Okay, I think that's probably enough for today. Let's go ahead and roll this up. We've been a little long the last couple days, so we're going to try to be under 20 minutes today. I'm going to scroll through this. If you see something of interest, just hit the pause button. Go to the hyperlink, get your additional information. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and certainly you note the full hyperlink down here at the bottom to go to the full set of all disclosures. We'll see you back here for the next trading session from the Falcon Global Market Preview. In the meantime, good trading and maintain your risk control.